You want to know what are the best stocks to buy now? I've got 10 stocks I think are attractive right here, right now, a combination of high growth as well as dividend stocks. Let's go. I'm going to start with the high growth name. This is a higher risk reward type of a name, more speculative, but man, absolutely crushed earnings. So check this out. A beat on the top and bottom lines, beat by 5 cents on the EPS. Revenue up 144.3% year over year, beat by 7.85 million. So Astera Labs had a beat on the top and bottom lines, plus raised guidance. Sales here, 173 million. The estimate's 160 million, so a $13 million beat. EPS 33 cents versus 30 cents. That's a 3-cent beat. On the earnings call, Astera Labs said this: our vision is to provide a broad portfolio of connectivity solutions for the entire AI rack through purpose-built silicon hardware and software to support computing platforms based on both custom ASICs as well as merchant GPUs. Significant progress towards this vision began in the second half of 2024, enhancing our revenue profile and delivering increasing value across the AI rack. What does that mean in English? Well, this is a smaller company and it competes against companies like Broadcom, much larger businesses. But Astera Labs is still able to bring in 74.9% margins. These margins are higher than Nvidia's, so they have pricing power. It means their products are in demand. Right now, these guys are doing it better than anybody else. Are there risks to that? Absolutely. That's why I said earlier, it's a high risk reward. This could easily be a bagger stock. It could also lose you money. We're talking about 144% growth. Here we're showing 200.19% growth. Is it expensive? Sure. Forward PE ratio here is a 52.97. That's non-GAAP. Market cap just under 12 billion. That forward GAAP PE ratio is going to be 144.52. Forward price to sales 16.77. So this is not a cheap stock. Let's take a look at a chart. Astera Labs was founded in 2018 by former executives from Texas Instruments, and this was a new IPO back in March of 2024. It's trading right now at about $72 a share. You can see it was $147, dropped all the way to $47. So this is a $100 drop from the highs. My preference on this is $65 or less DCA, and this is never a reason to buy, but you got 12 buys, 1 hold, and 0 sell. The average is $107.23. That's a 49% upside. This is a high risk, high reward, pure play AI name. The growth is out of this world. An ALAB could easily double your money in 2 years or less. Advanced Money Destroyer, Advanced Micro Devices, AMD also had a strong quarter this week. You got a beat on the top and bottom lines with growth at 36% year over year. Data center revenue growth of 57% year over year. On top of that, we also raised guidance. So a beat on the top and bottom lines, raised guidance 7.4 billion versus expectation here of 7.24 billion. Now there was some digestion after earnings, and some of it had to do with this right here. So AMD beat on earnings, but will take $1.5 billion hit to revenue from chip restrictions in China. Now, we've seen rumors in the last day or two about Trump removing these restrictions for companies like Nvidia and AMD. And of course, that would be huge, but it has not been confirmed yet. While we face some headwinds from the dynamic macro and regulatory environments, including the recently announced export controls, we believe they are more than offset by the powerful tailwinds from our leadership product portfolio. This is Lisa Su on the earnings call with analysts. The company remains confident in its ability to deliver double-digit growth for 2025, driven by robust client and gaming segment performance and accelerated AI adoption. Remember, guys, AMD we classify as the best of breed for data center CPUs. Nvidia, of course, is going to be best of breed for GPUs. AMD is going to be second place to Nvidia, but Nvidia has something like 92% market share for GPUs. So if I didn't already own Nvidia, you guys know that I've been long since 2017. My cost basis is $3.95. It's 12 or 13% of my portfolio. If I didn't own Nvidia stock, I'd probably be buying it right now. I've been buying AMD at $100 or less DCA. And if you look at the chart, AMD got to $227. We were trimming in Discord $200 plus saying, hey, this is overvalued right now. There's too much hype around AMD. Nvidia is still best of breed. But when AMD got to $100 and less, for me, it was just, I had to buy some shares. You can see the share price got down to $76.48, now trading at $103. Again, the preference is $100 or less DCA, but I still think it's a buy right here, right now at $103 a share. There's a decent chance you'll see something like 125 to 150 even in this year, 2025. And recently you probably saw the video I did on YouTube, my 2-year price target. The base base case 175, bear case 140, and the bull case 225 with an extreme bull case of 250 or more. Analysts 22 buys, 9 holds. The highest price target, this is a 12-month price target, it's $200, lowest is 95. So the average is $125.24, about a 20% upside from here. If you're a long-term investor, I think that upside is much higher. Google is rebounding today after dropping sharply yesterday, about 8%. And part of the reason for that, they came out this morning and said, we continue to see overall query growth in search. That includes an increase in total queries coming from Apple's devices and platforms. As we enhance search with new features, people are seeing that Google search is more useful for more of their queries. And this is why Google was selling off yesterday. So we had Apple's Senior Vice President of Services, who's talking about the iPhone exploring the option of adding AI search options to its Safari web browser. Now, let's be realistic here. If you guys are using AI, you're not using Google search as much as you were. So that's definitely a risk. But how much of that is baked in? Google, of course, is predominantly digital advertising. Still has strong gross profit margins, though, A+ on Seeking Alpha. This is more of a mature growth. In fact, it's a DGIF because it's paying a dividend now. You got a B- growth rate, 11.68% forward revenue growth. It's paying you this small yield, 0.55%, fairly new. So it's an up-and-coming DGIF. Now, valuation-wise, this is a GAAP 4P ratio of 15.81. The PEG gap TTM, only 0.45. It is important to note that Google now generates over $156 billion in revenue outside of their search business. So in orange here, this is going to be YouTube ad revenue. The purple is going to be Google network revenue. Green is subscriptions. And then you've got, of course, cloud revenue. Number 3 behind AWS and Microsoft Azure. And then other bets, Waymo, and so on is going to be yellow. So even if search is getting disrupted, the question is, what should this stock be worth? And of course, as an investor, you also have to be worried about the antitrust going on. And this is just one opinion on Seeking Alpha, an analyst here, but he's saying despite all these concerns, Google's diversified assets, including YouTube, Google Cloud, and Waymo, provide significant value and growth potential, mitigating risks to search. Google's valuation appears conservative with a 5x EBITDA multiple. Strong buy recommendation for Google. Fair estimate value, $232 a share, suggesting a 53% upside in 2 to 3 years. And it's trading right now at $156 a share. So yesterday, Google got below $150 a share, is about $148. I think it's a good buy, $150 or less DCA. This Fibonacci S3 is 129. It's certainly possible if we have a market sell-off. The recent highs here were $207. So significant pullback from $207 to $150 a share. But again, we're talking about under 16 forward gap PE with a small dividend. Are there risks to this? Yeah, there's risks to every investment out there. But if I didn't already own Google at $50 a share, I'd be a buyer. Under $150 DCA. This next stock has been a fired up wealth favorite since all the way back in 2020 during the heart of the pandemic. This was a Discord buy at $35 a share. And of course it ripped up, and then in 2022 in the bear market sold off again to that same price around $35 a share. And then rocketed from there all the way to $127 a share and plummeted to $47 recently. Any guesses? Marvell Technology sunk yesterday after postponing Investor Day and narrowing revenue forecast. I posted this in Discord. It does a good job of summarizing exactly what happened. So basically it's saying, hey, the macroeconomic environment is bad. The company is postponing its previously scheduled Investor Day from June 10th to a future date in 2026. Keep in mind that's calendar 2026. That's generally not going to be perceived very well by investors. The company also narrowed its guidance for the first quarter of fiscal 2026. Now sees revenue of approximately $1.875 billion plus or minus 2% compared to the previous range of plus or minus 5%. Now, Cantor Fitzgerald, because of this, downgraded Marvell Technology to neutral from overweight and lowered the price target from $125 all the way down to $60. He cited worries about losses in application-specific integrated circuits, or ASICs, for Amazon and Microsoft, with Microsoft potentially moving to Broadcom as soon as 2027 or 2028. Now, if you're in Fired Up Wealth and you're in our Discord, you know that Broadcom is my favorite between these two stocks. It's a more mature company with a higher dividend, but that's not really the reason why. Now, you could make the argument that Marvell Technology is only a $50 billion market cap and Broadcom is almost a $1 trillion market cap. So it's going to be a lot simpler for Marvell to do a 10x versus something like Broadcom. Going to 10 trillion dividend's not realistic. Recently, I did a top 10 high conviction stock pick video for the next 10 years, and Broadcom was on that list. There's definitely more upside potential on Marvell, but I have more conviction in Broadcom. And part of the reason for that is because it has a blend, about 50% of semiconductors and 50% software. And that's because of acquisitions like CA Tech, as well as VMware. So it's a much more diversified business and it's more established. But I do own both of these, and Marvell Technology does have strong growth, about 21% projected forward revenue growth. Valuation-wise, it's not cheap. 51.55, that's a PE gap forward. And it does pay a small dividend, 0.43%, but it doesn't have any dividend growth. So the street is chirping, and it's saying that Marvell likely lost a major design win. And like most semiconductor companies, it's gonna have risk to Chinese exposure. But looking at the chart, you can see it was $127 and it sold off to $47.09. This yellow circle we circled a while back on chart day and said this is the area DCA. We're at the very top of that circle right now. The S3 Fibonacci is $39.08, and it certainly could get in those levels, especially if you have a broader market sell-off. We still have to have earnings on May 29th, and that'll probably decide which direction the stock goes. I'm still bullish on Marvell Technology long. We're still under this major trend line, and the business has its hand in a lot of pots, not just AI. So just to give you a sense on that, you have data center here as well as enterprise networking, but you also have carrier infrastructure and automotive and industrial. Now, with that said, you can see on this summary here, data center revenue up 78% year over year. So of course, if this slows, there's going to be more pressure on that stock price. I think you have to be patient with it, but I do like this one long term. My preference is $55 or less DCA as a long-term investment. So back in late 2023, early 2024, we laid out phase 1 infrastructure for AI and phase 2. And you can see the names on your screen. Now, phase 2, this is data and ontology. So cleaning, managing, and sorting data, connecting data to LLMs. Now, as you know, Palantir has absolutely crushed it. Snowflake's holding its own, Elastic's doing okay. The one that's really not doing well at all is MongoDB. This stock is down almost 40% in the last 6 months. So what in the world is going on with MongoDB? Is it a buy right now? So last earnings report, we got weak fiscal 2026 guidance, multi-year deal headwinds. I'm not going to read all this. You can pause your screen and read through it. Increased investments and acquisition costs, broader market pressures, and competitive landscape, as well as valuation concerns. Earlier this year, we voted in Patreon. Which of these stocks do you want me to do a deep dive on? MongoDB won 58% of the vote. And this is extremely detailed. You can go read through it on Patreon. Now, competition is a concern, but MongoDB is the best of breed for what it does. But I want to break it down as simply as I possibly can. Growth in AI equals an increase in data volume. Remember, this is consumption-based. Increase in data volume equals more demand for complex data requirements. Increase in data volume complexity equals more consumption, equals more revenues for a company like MongoDB. The need for scalable and efficient data management will accelerate. AI adoption equals the need for latency minimization. AI adoption equals accelerated inference needs. Inference will be 90% of AI computing needs by 2030. And the global AI inference market is growing at about an 18.4% compound annual growth rate. So when I did the write-up, I said it wasn't a cheap stock. It's cheaper than it was, but it's certainly still not a cheap stock, and this is going to fall into that speculative category for most of you. But I do believe that MongoDB is uniquely positioned to benefit long-term for the following reasons. Growth in AI, increase in data volume, data complexity, the need for scalable and efficient data management will accelerate. MongoDB is investing in AI products and infrastructure for developers to make it simpler. And MongoDB is shifting its focus to enterprise. Now, you've seen this a lot where these SaaS companies try to shift their focus and it messes things up. Paycom is a great example the last couple of years. MongoDB will figure this out and the stock will be higher. For software companies, we like to look at the EV NTM revenue. MongoDB is only a 5.2x. Just to give you an example, a Palantir is a 70 plus, a CrowdStrike's pushing 20. And of course, a 5x doesn't mean an automatic buy, but it's just good for reference. The net dollar retention is about 120%. Where it lacks is that growth, and that rule of 40 percentage is about 25%. You want it 40% or higher. A recent positive, MongoDB was looking for a CFO and just appointed Mike Berry as its chief financial officer effective May 27th. So coming up here, Berry joins MongoDB from NetApp, where he served as CFO for the past 5 years and has over 30 years of experience. And many analysts are still bullish on MongoDB. This is saying that it remains on track for growth. So you can see Stifel reiterated buy rating on MongoDB lowered its price target to $275 from $340. But as you can see, the stock is $180 a share right now. I believe that this stock is broken, especially if you look at the technicals. It's broken. I don't believe the business is broken. In that previous slide, I showed you the reason it sold off, and it was a perfect storm and just terrible timing with market sentiment. So this was a trim at $500. It got to $509, dropped from $509 to $140. I like this stock as a long-term investment right here, right now at $180. Of course, the lower the better, dollar cost average. And you might have to be patient. It's not necessarily going to go back to $500 anytime soon, but I do believe the stock is worth at least $225 a share. I've got 5 more stock picks, and I'm going to bring them to you rapid fire. But before I go on, if videos like this are helpful, make sure you subscribe to the channel and click that bell for notifications. And please return the favor, drop me a like and drop me a comment. UNH had earnings about 3 weeks ago. It was a bad report, an earnings miss, and a significant cut to guidance. The reason was unexpected high medical costs and medical advantage. This was amplified by sector-wide concerns, as well as technical selling, and of course, lingering negative sentiment from past events. But it does pay a 2.15% dividend, 15 years of growth, only a 30% payout. That 5-year dividend growth rate, 14.22%, very strong. And it's trading at a forward GAAP PE ratio of 15.68. And over the years, I've been very adamant about not paying over $450 a share. Of course, now it's $387. So the lower the better. The S2 is $346, S3 is $267. I don't think it's going to get that low, but you could see $350. You could see below $350. I think it's an opportunity right now at $387 a share, dollar cost average. I just started a new position in the dividend portfolio and I'm buying shares. Confluent, April 30th earnings, beat on the top and bottom lines, 24.8% year-over-year growth. What's the deal? Well, the outlook was weaker than expected, but this did provide you with an opportunity. Just did a recent video on YouTube, told you I liked it, $20 or less DCA is above $20 now at $21.11. It sold off to $18.27. I still think it's a buy at $21 a share. Of course, my preference below 20 DCA. Nike, down 35.76% over the past year, down 21% year to date. Pays you a 2.73% dividend yield, 23 years of dividend growth, 10.61% on that 5-year dividend growth rate, and payout ratio just over 50%. Yes, there are risks with tariffs. I do believe that it'll get sorted out. We were buying this in the 50s in Discord. Right now, it's just at $60 a share. The S3 is $44.91. It certainly could dip lower on some sort of headline, but I like this stock in the 50s DCA. I also think Target is an opportunity. Pays almost a 5% dividend yield, 56 years of dividend growth. It's trading at a 10.57 forward GAAP PE ratio. Target dropped from $181 to $87 a share. I like this stock under $100 DCA. Eli Lilly. This stock was way ahead of itself. It was almost $1,000 a share, dropped to $677, and then it rocketed back up all the way up here to $900, pulled back recently on news. Got to the S1 around $740 a share, trading right now at $758. I prefer this thing under $700 a share, but around $750 long term, this looks like a good opportunity. Last but not least, if you want to own semiconductors, the new oil as an ETF, look at SMH. Went from 283 to 170. It is back to 224. I do think there's upside here. You'll probably see $250 a share sometime this year. If you're new here, make sure you subscribe. Drop me a like. Drop me a comment. Thanks for watching. Have a great rest of your day. Take care.